welcome back to Dukascopy TV. Today I'm joined in the studio by Daniel Haefeli from the Geneva Association, and we're talking systemic risk in insurance. Daniel, thank you so much for joining me today.
It's my pleasure.
Now firstly, can you tell me a little bit about the Geneva Association's involvement in systemic risk?
Well, the Geneva Association has been very prominently involved during the last 4 years since the outbreak of the crisis, basically. Mainly looking at the question how to identify systemic risky institutions within the insurance sector.
And regulators be looking at systemic risk, or are they already?
Of course they have to. I mean, experience have told us what damage this can create. Even in the insurance business they have to look at it, but, and that's our demand, they have to do it on a well-targeted manner, targeted to the insurance business model. That's a fundamental thing which we think needs to happen.
And how does systemic risk affect people in the insurance industry?
Well, I mean, the insurance company, I mean, once you should be designated as a systemic risky entity, I mean, then you have certain consequences and policy measures to bear, like additional capital, like enhanced supervision, like recovery and resolution plans. So that would be the consequences of being designated as a SIFI.
And what about in banking? How does it affect people in banking? Well,
the banking, it's a bit different because the banking business model is as such that this maturity transformation, which is the key element of the systemic risk creation, is a fundamental activity of a bank. As such, I think there is no surprise that banks, big banks, are designated as systemic risky institution, and of course they have as well certain benefits from that. It provides them with a governmental guarantee. It might help them in the funding conditions. It provides them as well some benefits. So therefore, I think it's relevant that the banks are very clearly have to take as well the consequences of that. Whereas for the insurance business, I think this whole systemic risk topic is a completely new area, and it's something which really has been coming up during the last couple of years only. So it's a very new thinking which we need to adopt first.
And can you tell me just some of the differences between the two industries of banking and insurance?
There is fundamental difference. As I said before, banks, and that's the basic activities, they have to manage maturity transformation, and mainly short-term funding, complying or matching long-term assets, mainly very often illiquid assets. And this is basically what creates, consequence out of this can create these liquidity stresses, which then is a fundamental element of systemic risky events, which then creates immediate failure of banks. And when I talk immediate, it's a question of days. I mean, as we have seen in the case of the Lehman Brothers, where in essence leaders had to decide over a weekend what to do. This is a complete different, insurance works completely differently. We have in the insurance business, we see long-term liabilities. They are upfront financed by the policyholder's premium. So insurance entities do not depend on third-party financing, or to a much lesser extent. And the basic concept of insurance is as well to match assets with liabilities.
And what do you see for the future of insurance moving forward? How are the markets developing?
Well, again, insurance is of course in a very difficult situation. There are some I not want to say threats, but some concerns which they have to live with. One is definitely the low interest rate environment which we have, which basically penalize all the savers. And insurance is nothing else than a saver on behalf of its policyholders. So as such, they are penalized by this short-term investment, because typically you have guarantees in your liabilities and you should meet them with your return on your asset side. And of course, having these low-term interest rates, which we see now, that's quite a challenging task to do. Secondly, I think we have, of course, this higher frequency of catastrophes, which, by the way, underlines the social and economic value of insurance. I just was in the US, and you can see some consequences of the last storm they had. They're quite impressive. This is a concern they have to live with, but that's their business. And as a third one, I would say it's the longevity, which is a very long-term change we have to live with. People live, fortunately, longer than in the past, but this has some consequences in the whole pension, retirement, saving, and preparation for retirement of people. That's basically, I think, the three major challenges insurance is faced with at the moment.
Well, Daniel, thank you so much for coming in and sharing your insights with us today. Just lastly, we're going to go on to our Dukascopy question. So we ask every guest that comes into the studio, if you had $1 million to invest in the market for 1 year, where would you put it and why? And these are your options.
Okay. I mean, I described the long-term nature of the investment of insurance. So it's not a typical question for an insurance person. But in 1 year, I would say probably equity.
And why would you put your money in equity?
Well, typically equity are liquid, so you can, at least if something goes wrong, you can get out relatively easy. But I think we see some signals, in particular in the US, where economy is going to the better at the moment. So I think there is some potential, upside potential in the liquidity market.
Well, Daniel, thank you so much for coming into the studio. I hope to see you again soon.
Thanks for having me with you. Thanks very much.
That's all from us here in the Dukascopy studio, but remember you can join in with any of our live daily webinars by going to the Dukascopy website.